That's all. No other hidden costs. And this is the two type account. One is called a cash plus and one is called a cash management account. I think I repeat it many times, okay? But Philip Chairman has said that sometimes you need to keep on repeat that people remember. Okay, so as up to today, I still got question. People ask what I do with these two accounts. Okay, if you just want to buy Singapore shares and keep in CDP and hold for long term, use the cash management account. Okay. Although higher commission rate, but it's mainly one off only because anyway you don't plan to trade, you plan to keep for long term. Okay, then use a cash management account. But other than that, I would say that default use cash plus. Other than that means what? If you have to use CPF or SIS to invest, whether long term or short term, cash plus account. If you want to buy Singapore shares using, but you don't plan to hold very long term, use cash plus account. And if your account has more than 250,000 inside, you can also use cash plus account for long-term holding of Singapore shares. Okay. And for US market and foreign market, default cash plus account, please try not to use cash management account because the commission is higher. Okay. And for unit trust, any account is fine. It's just which one you prefer. Some of our clients like to use the cash management account to buy unit trust, and then they use a cash plus account to buy shares. So they say that they have a segregation. They will not mix up. Okay, so it's up to personal preference, okay, on your side. And for me, I use cash management account to buy Singapore shares for long term, and I use it to buy unit trust. And for other foreign share, I use cash plus account to buy. So depend on what is your preference on that, okay? So that's how I do for my own segregations. Okay, but for Singapore share, not for longer term one, or for my YouTube portfolio, I use a cash plus account to buy. And for parking money in Poem's account, there is something called a smart park or called money market fund. Okay. And do know that money market fund returns have been coming down recently. Okay. Hope that you bounce up again because interest rate go up and down. And you can see that the latest money market fund actually fall below 3 now. It's 2.92. Do not be panicked. As what I mentioned, the interest rate is supposed to come down. Okay, expected to come down. When the Fed going to cut rate, we don't know, but market always move ahead of that. For example, my own personal housing loan is on floating rate, and I received a letter from DBS say that coming one, my interest installment for the housing loan will drop. Okay, so even the banks also cutting my housing loan rates. So definitely they will cut their fixed deposit rate, all this in that aspect. Okay. But of course, you still remain volatile, you fluctuate a while. I think you go up 3, then come down, but the trend is definitely on the downtrend for interest. That means all those very safe products, the good time is over. I would say the good time is over already. Okay, so you need to start to think of how to redeploy your money and into that. And a lot of people ask the question of any safe product now. And when it comes to investment, I need to emphasize there's no safe products. Everything carry risk. The only one got no risk one, Singapore savings bond, T-bills, and Singapore government bonds. These are the only one, no risk. Okay. Insurance company, savings plan, capital guarantee, no risk. Okay. If not, other than that, all have risk. So there's no such thing called safe unit trust, safe ETF, safe stock. No such thing in the world. Okay. All will suffer losses if you go in at the wrong time or if the market comes down. Okay, and this is where investing is important. Picking the right way, right timing, or right counter is very important on that for long-term profit. Okay, this is our Jurong East. For those that want to open a Jurong East account, you can scan this QR code. And for those that are client, you can just scan this QR code to generate referral code to send to your friends. Okay, so that they will benefit it, and you also being paid $68. And any issue, contact our Jurong East team. Okay. And this is currently the promotion. Okay, the stocks have changed for new account. Now they change to Hong Kong stocks. Okay, or actually they don't change Hong Kong. It's still US stocks, but it's China stocks. For example, JD.com. Okay, but it's listed in NASDAQ. For those that open a new account, we ask if they fund 3,000 to 3x8, they will get 2 JD shares, not 1. Okay. And JD.com good for options also. Okay, and for deposit 10,000, okay, and 10,000 and do 5x trade, you got 2 JD and 2 Baba shares, Alibaba shares. Okay, so and do take note, this will be only for new account holder, but for those that have successfully referred them in, okay, you will get $68. And those new account, you have 3 months of zero commission trading for US shares. So what does that mean? Means that you get these two JD shares, you don't like, you can just sell it off at no commissions. Okay, and actually, I don't think the price will be important to you because it's free one. You can just sell and profit. There's no commission you need to pay on that. So that is what it's called zero commission. There's no something you tell you, oh, you need to pay platform fee, oh, you need to pay settlement fee. Nothing. It's zero means zero. Okay. Okay, so this is the QR code. For those that want to refer your friend, you can scan this QR code on that. Okay, but for those new account, remember you must go into your Poem 3.0 apps to do the redemption. It's not just really assume that you will automatically be zero commissions. Okay, you must go and click redemption. And you got issue in doing that, talk to us separately. We are able to guide you on that. Okay. So this is the QR code again. Okay, next is just one new news. It is started, today is 26, right? Yeah, today is 20. So it started only today for those that not aware, for those that trading US market. And you know that US, there's something called a pre-market and there's also a post-market. That's not, okay? So to trade US market, you can actually, now is 8 o'clock, but actually you can buy US share now. You can buy and sell US share now. And this is what I call pre-market tradings. Okay, pre-market trading. So pre-market trading start at what time? Start at 4 o'clock. Okay, for today is 5 o'clock because today is the non-daylight saving time. Start at 5 o'clock. You can start to buy and sell US shares until 10:30 before the market open. So this is called pre-market trading. And the market will close at 5 a.m. in the morning. Okay, but after 5 a.m. in the morning, market close, you can do post-market trading. You can buy your share from 5 a.m. to 6:30 in the morning. Okay, so practically, for US market, actually is a very long hour. Okay, but of course, the main activities always happen during this part. Okay, this part. Okay, but pre and post also can do trading because sometimes I sell share before market open. Because sometimes pre-market, I see the share price very high, I sell. Because maybe after market open, it may come down. Or maybe the other way around. Okay, so this is where you can do pre-market investment on US market. If that's something for those that know, right? Okay, do take note the free share is only for new to Philip Securities. If you already have a Philip Security account, don't have Philip only one new client, just a bank, one fixed deposit, the only one fresh fund. Okay, you don't say that I take from my saving account transfer fixed deposit, bank will not give you that interest. Bank say you must take your money from another bank and deposit in that then count. So same thing for points account benefit is only for people don't have any relationship with Philip Security at all. Okay, so that's to clarify on that. Okay, and also that for options, this is the activation. You go to here, option, you can activate option tradings. For those that are not aware, Philip can do options also. Okay, which why I say jd.com for trading purpose. For long-term hold, you may want to look at it. To me, because I got position for jd.com. Okay, and also that do take note that these are the live prices you can subscribe when you go to subscription. Okay, US market is live price. Please just subscribe, it's free one. And you want to buy US shares, you must buy in live price. Okay, please don't use delay price. And same thing option, you also do live price. Okay, so anyway, it's free one. You just go and subscribe to it. Any different keying in transaction? No different, but for pre-market, you need to subscribe for pre-market. It must apply. Okay. Under the risk warning statement and application, you must apply that you want to subscribe for pre-market because they will have a risk warning statement to tell that invest in market, you got risk or this thing, you must acknowledge that. Then you can do the pre-market investment already. Okay, there is a tab called maybe, okay, since you asked me that question, let me just see. I do a demonstration. I see which of my account got pre-market one.
Mhm.
Okay. Now let me show you. This is okay. This is live account. This is my account. Okay. Let's say I want to buy. Yeah, there Honeywell. Okay, because I recently just buy Honeywell. So you want to do pre-market, right? Okay, you can see my screen. Okay. This is extended market or RTH. Okay, pre and post market is here. This is regular trading market. So you want to do pre-market, you have to choose here one. Okay, not here. So you choose here, they ask you to acknowledge all these things, then you can do pre-market. For normal market is here. Okay, normal market, you click here, the trade not to be transacted. Pre-market, you click here, the trade not be transacted. Okay, so it is different type, but everything is the same. Commission is still the same, exactly the same. Okay. Okay. Next is now this is the wait. Okay, this is a QR code. You can scan on that. Okay. You will lead you to a QR code. On that, they can ask our drawing team, we can send it to you also. For website have that one, the account will go directly to the house team. Okay. Then your client call us, I will say that we don't know him. Because we really don't know him. The company will just take the account. Okay, then they need to talk to someone from the company. So this one, the account will directly take to our team. Okay, on that. So that is a QR code on that. Okay. Got GTD order. What do you mean by? I'm not going to talk about Boeing account today, okay. So Boeing account, maybe talk about that separately, okay, on that. Okay, currently for GTD order, I think only on the Poems Pro have, not on the normal Poems account, okay. And you see I don't do GTD order, I just buy direct from the market. Okay, so from this is unit trust. If you have to transfer unit trust in, anyway, we don't charge any fee on that. Okay, and you transfer cash unit trust in, you'll pay you every $10,000, we'll pay you $20. Okay, for the unit trust you transfer in. Can be from anywhere. Okay. And this is our Well Hero broadcast chat. For those that are not in, you can talk to our team. They'll add you in. I think every day there is a stock call. Okay, but do think the stock call is not for long term, it's more for short term trading. You want to look at buy and hold. Please don't take the short call and straight buy and think you can hold long term. Okay, that's mainly for short to mid term. Okay, this is a 6% guarantee promotion. I think some of you may be aware of that. Anyway, we'll be closing in March. This is provided you buy a savings and retirement plan with us. Your money market fund will earn guaranteed 6% return for a 3-month period. Okay, this one you interested in that, you talk to us separately. Okay, now let me see, is Chung Wei here or not? Okay, I think Chung Wei, are you there?
Yeah, I'm here already. Sorry.
Okay, good. Okay, so before I talk about Asia market, I let Chung Wei talk about US market first. Because that's our tradition. You kickstart the US market. Okay, Chung Wei, maybe you want to start your US market first.
Okay, let me just get my slide up and also share the thing. Give me a minute. Let's see, how do I share? Where's my sharing button? Okay. Share. Okay, share desktop. Can see or not? Can you all see the screen?
Yes.
Okay, good. Okay, today I would say do a little bit of adjustment. I don't go deep too much into specific stock, but maybe a few stocks to just talk about growth comparison and all thing. There's a couple of people asking about AI stock, but start with market overview. And mainly US has been so high, so what to watch out, the relationship of US debt, inflation, geopolitical conditions and all stuff, what does it mean? I have about 20 slides actually. I thought I can reduce it, but apparently still got a lot to say, okay? So without delay, I'm going to jump into the market overview with typically what are the indices and all things. As many of you know, the US key indices, if I look at 1 year until now, it has gone crazily high, especially in NASDAQ, 47% over 1 year to now. And even S&P 500 also about 26%, which is a very phenomenal growth, I would say. And even Dow Jones also very good. So those are all fantastic growth. And if I look at just purely from 26 October onward, why 26? 26 is where Janet Yellen mentioned something about delaying the bond auction and all things, and it triggered a lot of, and also Fed also mentioned about possible rate cut and all things. This is where it triggered all the big jump. So if I just purely looking at this, how come it's not moving? Sorry, when my screen is not moving. Okay, can. If I just looking at purely the October 26 until now, you can see that both NASDAQ and S&P 500 actually move very closely. In fact, S&P is slightly higher than NASDAQ, 20%, 21%. Dow Jones also moved phenomenally high too. Interestingly, Dow Jones was also 18%, even though it's only 30 stocks and a lot of them are traditional stocks. But during this period, there's quite a bit of some of the traditional stock also continue to move high too. So if you ask me now, well, good news. If you have started investing last year, continue to stay invested in S&P 500, even just buying the ETF, you have made a good fortune, I would say, just sitting around. The good news is that it seems to be still pushing forward. Of course, it's quite a high risk now. Let me look at the next slide. If I look at the key indices for February alone, even using a weekly chart, it almost break all the different, last high and all things. And sorry, I need to remove how do I remove the annotation? Let's see, there's the eraser. Let me remove the eraser. Okay, let me see. Clear all drawing. Okay, so it stays pushing higher. Everything going up. However, I noticed that the RSI is all greater than 70 on even for a weekly chart, which means that it's overbought for all three key indices. So overbought means people are overly excited getting into it, and ideally it should have take a breather and come down. NASDAQ came down slightly on Friday, but for now I think the other two is still moving strongly up. So good and bad news, I would say. The good news is strong. The bad news is, can it sustain or not? Personally, I also worried when it goes up so high. The thing that I will be watching is whether there's any negative news on the market. Okay. Why my screen is not moving as much? Let me see. Okay. Okay, sorry. So if I look at what drive it, again, back to the 7 mega tech stock. To be honest, I think we got to change it to maybe only 4 mega techs, or maybe even one only, because if I look at February itself, the two stock that actually move up a lot is Meta, which is Facebook, and Nvidia. The other rest are marginally higher. I wouldn't say huge, a lot more. Even Microsoft have gone up and hold on to that. So these two, Nvidia and Meta, are the one that is propelling forward. So as you know, last Thursday, I think Nvidia stocks jumped almost 20% on earning outlook very good, earning result very good, and that's why the reason why later on I will cover a bit more on the earning result and also how to look at the progress and all stuff. Okay. What else? Let me think. So I guess the initial rise of all this is mainly on the the potential rate cut since October. And then after that, there was good earning in first part of January. But then subsequently, as the news of the CPI getting a bit on the high side, PPI also on the high side, it started to drag down the market a bit. But on Nvidia earning, it actually pulled the whole market up again on last Thursday. So one stocks actually helped pull all the three indices. Impressive. Okay, so the next thing. So basically in the key indices, mega tech stocks still are the main one, although the traditional stock like oil and gas and all these things are also doing quite well, partly because oil prices came up a bit to $80. But other than that, I think we'll still be looking at mega tech stock. But what to watch in the future, I would say a few things I would look at it. One is, of course, US dollar strength. Why US dollar? Remember last month, if people who attended last month, I did talk about the dependency on the US dollar, US debt, and the military. So I will cover a bit of that, US bond sales and treasury yield, US inflation, CPI. These are areas to watch because it will impact whether US market will continue to be as hot or it may a bit of not as hot, but still going up. I think the momentum is still good because I think their GDP, their job growth, their inflation, although creeping, but not excessively. So if it's well managed with rate not overly too high to kill any of their banking issue, it should be still okay. So this was the slide I shared last month, which I mentioned about the fact that the US dominance, the power of US is dependent on their US dollar, which they can print freely, partly because it's a reserve currency. Everyone trade on it, and financial institution, financial market uses it heavily. Euro is the next one, but it's still far distant second. And then US debt. Ability to continue to print the debt and people to buy the debt will help to maintain its ability to just print the money and don't have to be burdened by the fact that they have to pay for the debt and they go bankrupt because they can just print freely. And partly they can do that is because they have a bit of the US military mind to push people who don't listen to them, okay, to kick their ass. To be the not so nice word to say. So that's kind of interdependence. If any one of these break down, it actually will affect US dominance. Okay, so let's talk about US dollar first. The US dollar is the most widespread use of the currency, partly after 1945, after Second World War, after they take over the British pound, they progressively become the look after because they were backing with gold. Okay, until 1971, when President Nixon take it off from gold backing. So in the past, you can take the US dollar equivalent of a certain amount to change 1 ounce of gold. But as the Vietnam War dragged their economy, dragged their whole country, they took off that gold backing. That was a major shakeup in their. So basically, from a commodity backed hard currency. Hard currency means something that is backed with certain hard commodity to become a fiat currency. In 1971, it became a fiat currency. Basically, fiat currency means that money that the government guarantee as legal tender. So you believe in it that it will be guaranteed on that sense. Okay. So all fiat currency in the world, none of them will survive. Every fiat currency in the end turned to zero. Okay, because there's a human factor to it. People just print, people don't control, and fiat currencies just collapse. You can quote out of Africa or the South America or the different currency. But the smart thing of U.S. President Nixon, which through their Treasury Secretary, they use petrodollar to back the currency. So every oil that is purchased around the world after 1971 through the working with Saudi Arabia must use US dollar. So it makes US dollar have to be traded and have to be used. So that helps to sustain their dominance in them. And interestingly, anyone who want to touch their golden rules, like Iraq, Saddam Hussein started with the euro-dollar oil trade with Europe. There was a 2003 Iraq war. And of course, we know the history. He was captured and was killed. Of course, the reason is there was mass destruction, and I was thinking the white powder, there was no mass destruction. It's purely a global power do not allow another country to shake their base. Okay. Of course, 2008, 2009 global financial crisis, QE was printed and all things. In this case, I think there was a history behind it. US was in the verge of collapsing. I think China came to their aid. Of course, Russia was watching closely and actually do not really support, but because China being a big economy helped to buffer some of this and they survived through again. 2011, another smart Alex or smart leader, Gaddafi, want to use gold standard. I think they call it Africa dinar or something like that. Some currency using gold and using that to buy their petrol. Again, what happened? He was captured and murdered, right? So anyone who want to touch on anything that will affect US reserve currency will be affected, okay? Of course, 2011, US actually become net oil exporter because of their, the fracking oil capability that they created. They managed to pull out more oil from their own oil field. So they become a net oil exporter. This actually changed the formula. Last time they depend on Middle East, and Middle East will buy their debt when they sell the oil. And then suddenly they also competing with the Middle East oil. 2018 actually is an interesting years when I dig through this. The Chinese actually, or the China actually worked with Saudi Arabia with a contract on some oil pricing using CNY or Chinese renminbi yuan. Okay, if you look at it, Trump actually started the trade sanction or trade war with China in 2018 August. Okay. So there is some reason behind why this thing happening and all thing. Of course, 2020, 2021, there's COVID, and then we went into extreme QE, which we have this current problem. 2022, again, Ukraine war happened again. Russia was taken out from their SWIFT system. So of course, they wanted to collapse Russia, and hopefully that it will also affect China in a way, but they failed because of the Russia central banker has smartly removed the dependency of US dollar debt and all things to very minimum and forced everyone to use ruble or other currency to trade with them. So this touch on the fact that a fiat currency which is not backed by a commodity has a risk that people can just don't use it anymore when they can find alternative. Of course, in the US dollar case, because it's so widely traded in the financial community as well as the international trade, this is not possible, not in the near future. In the next 5 to 10 years, at least we'll still be there, okay? However, in the 2023, I think there is also the BRICS expansion, bilateral trade more and more by inter-country currency. This is all shaking the US dollar dominance. So take note of that, because that's why we need to watch how it moves and whether US economy can continue to be strong. This is a bit of a look on, I have two charts here because one of them is from 1967 to 2015. The other one is kind of after that, how it looks like. If you look at it, in the big picture, don't forget, US dollar index is actually a mix of how US dollar compared to the different currency like Euro, Japanese yen, British pound, Canada, dollar, Korean, and even Swiss franc. So there's a certain percentage in there. So sometimes when you see up or down, it doesn't mean the US dollar becomes stronger. It may be the other currency becomes stronger or become weaker. So it's kind of relative, okay? But from that perspective, just to note is US dollar index has been declining. It might have picked up and come down, but if you look at it in the high of the Latin American currency, it was in 160 plus to 165. Then now it's in the region, last few days, only about 103, 104. So the indices is in a declining mode. It may come up, but it still come down in a long-term declining trend. Even a dot-com burst and even a housing bubble, you can see it come down and go up. But one interesting I want to kind of share here is whenever there is a war, the US dollar also always go up. So sad to say, I say US is a warmonger empire. Okay, if they want to make their country strong, they create war, they create dispute, because when there's a war, US dollar is easily traded and people will just buy their currency, so it becomes stronger. So it's a bit of a very sad reality, but it's true because they are the most easily widely traded currency. Okay. The only time like COVID-19 came down because their economy also was affected. Because of the blockage around the whole, so this thing came down. But you can see that in last year as their economy pick up, so the economy plays a part. Again, I mentioned that US dollar index depend on other currencies. Sometimes it strengthened partly because euro weakened as euro depend on oil import and the oil import is expensive. It has affected them. Okay, so I better skip on this US dollar now. So I'm jumping onto bond. The treasury bond in US for 2024. There's a point. In early February, there was amount of 42 billion 10 years note that went on auction, but it was well sold during that time. And recently, there's another 20 years auction which didn't go as well. Okay. So there's still some resistance, there's some risk in there. And what happened is this year, they have about 8.9 trillion of government debt that is maturing this year. So when they mature, they either pay back or they have to reissue new one to cover the old one. Okay. So imagine that when you mature means like you buy a bond, right? When you mature, you get the capital back, right? So country that buy your bond, you will expect US dollar capital to be returned to them. In order to continue to roll the ball, they may have to issue 8.9 trillion plus it is estimated they have about 1.4 trillion of deficit spending this year. So that will mean that total of 10 trillion this year they have to be issued out. Okay, that's a lot of money that they have to issue out. So the question is, who is buying? Okay, I mean, we all heard the news that many country is taking a bit of careful steps not to buy too much of their bond. So there may be some risk in there. So that's why watch carefully how their bond auction progresses. It also affects their yield rate, which is the next slide I'm going to talk about. Last 2 weeks, interestingly, US 10-year broke above 200 days. So it was if I look at 10 years, it was coming down because after the October, while everything was looking good, suddenly it stopped picking up again. And partly because the fact that the auction may not be going as well, the CPI comes up, so the expectation of higher yield in order to buy your bond. So it's reversely kind of you got to sell me cheap in order to give me higher, or you give me higher yield rate in order for me to buy your bond. Okay, so which is why you can see there's some uptick on their bond rate. Although last Thursday, Friday, it cooled off a bit to 4.25. Still, it tested the October 22nd high, but it came down. Okay, so but you see a trend of pushing it up. I suspect it will not push too high because too high it will be too costly for US, but it may not be under their control because if they want to issue so many treasury bonds, they need to make things attractive for people to buy. So you can see that why there's news that Janet Yellen is planning to visit China again. Again, trying to get people that who is the biggest buyer of bond. And recently, the last 1 or 2 months, I think China bought a bit of their treasury bond. It's like after their APEC meeting, I think Mr. Xi Jinping and President Biden probably have some understanding. And sometimes they are two superpowers, they still depend on each other, even though there is a lot of tension in them. Again, if I look at the CPI, so CPI is another interesting watch that you have to, it has the long-term goal of a PCE or the core core CPI, core PCE is 2% and all things. It has been hovering from about 3%. And if you look at monthly changes, it start to uptick. So that's kind of the worry that triggers some of the earlier slide I showed your treasury yield to be higher. And then the forecast on the future rate, how it's going to be, you can see that this is now 4.6%. Oh, sorry. 4.6% means the typical short-term loan interest rate will be at 4.6. So it's lower than current 5.5 to 5.575, 5.75%. It's lower, but it's not significantly lower compared to last time. So it's down from 5.4% last year. And this 2024 forecast is 4.6. The other thing is showing is that instead of initially there was a very optimistic many rate cut, 7 up to maximum 7, now it's down to about 4. And you can see that the first rate cut is not likely to happen in March. It's probably going to be in June. This is also another interesting thing to watch is that does it mean that because to keep the rate high, the US dollar will continue. The rate and US dollar has a certain implication. When the rate is good, of course, then when we buy T-bill, right? When the rate is good, we put our money into T-bill. We don't want to put into risky investment. Likewise, people like Warren Buffett also buy short-term US Treasury bill, 6 months or 1 year, because it's at 5.5% without no risk. Why not, right? But keeping it high will also mean the cost of rolling out new treasury. Notice early on the slide I mentioned about they are issuing 10 years and 20 years bond. They can't continue to issue short-term bill because that is too costly at high rate. So the best thing is to try to issue long-term bonds so you can stabilize your cost of capital for long-term. However, you also don't want to issue it at a high rate. So what's the right number there to hit on? So there's a push for Treasury pushing Fed to cut rate, but Fed is pushing back to safeguard their what they call it, their CPI or their inflation. That's what the Fed say, but the reality we do not know because there's an unsaid rule. The Fed job is not to fight inflation only. Is to keep US dollar dominant, keep US dollar strong in the world so that people will buy. Okay, so there is hidden rules. So what does it mean when short-term and long-term you have inverted yield? And inverted yield typically from the past history and all things shows that there will always be a recession. Somebody asked a question, will there be a recession? Typically is 6 to 18 months, nobody knows. But we have been in the negative territory for a long time. So this is probably the biggest dip and inversion, but yet it hasn't come in because I think there's 2 factors to it. Number one, so much money is printed in the market and President Joe Biden actually uses a lot of the money is like helicopter money to the people. And the people created consumption. Okay, so that's why the economy looks very good because it's like give free money to these people, money survive through the slow period, and now job come back. They have more job. The inflation keep peaking, but their pay rise increases to cover the inflation. So all this help to continue to drive their internal consumption. Bear in mind. In US, 70% of the GDP comes from internal domestic consumption. So if the domestic consumption maintain, the economy GDP will look good. Okay, so that's kind of the interesting US environment versus China is mainly export plus trying to drive their domestic, but still okay, put it this way, Chinese are more conservative. The saving rate of China may be very high at 40%, but they are not willing to spend when they see some danger or risk ahead. Economy is slowing down, so they are not spending. So that's the struggle that China has in trying to kickstart their domestic economy or domestic consumption to buffer their export drop. Okay, that sidetrack on that one area, but that's kind of the different set of problem. One set of problem in US is their debt, whether anyone want to buy, to make sure that they can continue to be, like Tai Long, they continue to borrow money and spend like nobody business. But China's side is how to make sure that their people take out their saving and consume so that their economy is better. So it's a different set of problem. So the next thing to look is US credit card. So you can see that US credit card has hit the highest, another record high. It's 1.13 trillion. And the delinquency also went up. Why I watch this is partly because the higher it is, the danger it is, people cannot pay and then you have to bad debt and all things. So we have to watch this closely. Okay, watching my time, I better start rolling out faster. Regional banking, also another area. You might have heard about the impact of a lot of these regional bank during the very cheap, low interest rate. They put a lot of deposited money into long-term bond. And the long-term bond, when the interest rate when the treasury yield went up, their bond price went down. So their balance sheet is affected. The other thing is also regional banks are more exposed to commercial building loan. So that is also hitting their balance sheet as well as their cash flow, in the sense that imagine the local REITs or local factory who buy a certain big building, take a loan from you, and then unfortunately business is not doing well, or the commercial building is not, because people enjoy working from home, not going back to the office building. And all this occupancy is affecting their what they get rental, and it affects the payment to the bank, and the bank may have a liquidity issue. So these are the things that is dangerous for them, especially when the rates stay high. So there was a bit of breather when last October there was news of a rate cut, everything came back better, but lately the rate cut seems to be pushed out. We have to watch how the regional banking progress. Okay. This can be seen on this chart too. This is the Fed balance sheet, and they are trying to reduce their balance sheet partly because they have printed so much money, 3-4 trillion. This is on the right hand side. This chart, you can see that they have successfully reduced until March last year, when you have SVB, Signature Bank issue. They have, instead of quantitative tightening, they have to do quantitative easing. That means they have to let go more liquidity into the market. And interestingly, the last few months, there has been more and more occasion of this thing happening. So apparently in the market, there's some liquidity challenge. I think last year they also issued a new instrument that will expire somewhere around April or May, if I'm not wrong. It's called TAF or something like that. And that one is also a kind of alternative to help them on the liquidity. Which is what I would say April or May may be an area to watch whether they get over this issue or not, or the US Fed may have to cut their rate quickly, or something else that may have happened. Okay. So notice that August started, December, January, February, a few small liquidity pump into the market rather than continue to reduce their balance sheet. Next, I move to geopolitical outlook. This year is an election year, big election, and the biggest is US election. And we all know about Trump and Biden as the forerunner. Both have their sets of problems. One is either getting a bit too old, sometimes miss speech and all things. The other one get a bit unpredictable on his action. So these are all uncertainty may affect us. Russia has an election too, and but likely very little surprises, unless recently there's this opposition that was found killed or found dead in his prison. Will it cascade into other problems? We do not know. So we have other elections that we have to watch. But the US-China tension will continue to be there. You notice the AI tech restriction, whether it's chip, data, cloud, and all those things, is still pressing them. One end pressing them, the other end, Yellen is visiting them and say, hey, can you buy my bond and all those things? So it's interesting. It's a very delicate relationship, but yet they want to position themselves, US want to position themselves to bring back their tech and their manufacturing into, especially semicon into US. However, China is also putting a lot of attention into their own area to beef up their shortfall in those areas. Most recently, I saw something about Xinjiang, even Volkswagen built a product in there, or BASF Chemical built a product in there. If there's certain component that is affected with Xinjiang, they want to ban them from exporting to US. So you can see the extremeness of their political blockages might cause dual supply chain costs and capex efficiency. That means people have to invest in other places and all things. BRICS and Shanghai Corp's expansion, these are going to affect US dollar dominance, because as more trade, international trade is trade in non-US dollar, it will affect their ability to influence the market. Japan rate also has another impact that we have to watch carefully. So I would say these are the political outlook we have to be careful. This slide, I wouldn't go in detail. I think last month I did talk about it. There was the Red Sea. It went all the way to 3009. It came down. So it didn't go down to recover to the pre-Red Sea level. Oil price also went up, but it also came down. So we're still watching closely. But I think this is another indicator we'll watch, whether the geopolitical instability or concern about price of oil will affect and shipping will affect the inflation in future. So these two, if going up, is no good for US also. So next, I'm going to switch on bit on NVIDIA and other tech. I did a bit of slides, and also, I mean, the fundamental, their revenue and the profit, and also their pricing movement. Just to share why when we look at stock, when you want to buy stock, I think the key thing is don't just follow the movement of people say AI is good, just jump into it, but you must know what's behind it. Okay. Definitely, NVIDIA has gone up. I was recalling the first review I shared in May. Actually, I talked about possibility to buy NVIDIA. If anyone who buy NVIDIA and hold until today, you will be laughing to the bank. Okay. Unfortunately, I myself also sold before even hit 700 or 600. So I myself wasn't as smart as many others. Okay. Here, I put here year-on-year growth and quarter-on-quarter growth. And if you look at NVIDIA, why the price had gone up so much? Compared to last year, it has gone 265% up their revenue, okay? Their profit has gone up 768%, 7 times, okay? Quarter-to-quarter, 21% and 32%. Of course, that propelled the excitement on these stocks, because it's doing very well. I think before the earnings last Thursday, there was a dip because people were expecting that can they sustain their growth so much or not? And they beat the expectation of analysts. That's why on Thursday, it jumped 20% or almost 20%. So why certain stocks move up is because their revenue, the top line and the bottom line. In business, we call it the top line and the bottom line are doing very well. And their outlook, they say, is also doing very well. Those are the factors that will drive the excitement and the energy to continue to buy the stock. Let's compare this with Tesla. We know Tesla was doing very well, EV and all things, right? But it looks like they are becoming like a small, typical car manufacturer at 3.4%, 7.7% growth in top line. The bottom line looks very good, partly because there was a tax rebate. Okay, so take away the tax rebate, it's not as good. So you see the price movement is being driven by that too. People anticipate. Plus, and another thing I never mentioned is there competition that is going to challenge them. NVIDIA, right now the nearest competition is probably AMD, but AMD is also overpriced, more overpriced than NVIDIA. So from that perspective, NVIDIA may be even a better bet than from a PE level, right? But Tesla, China has a lot of company that is going to take their shares. So that's why the market will react to their stock price too. So it's coming down. Then let's look at another company that is very common to us, Apple. Apple has been the star player in US market, $1 trillion company. But if you look at their growth versus last year, only 2%. Of course, last quarter is 33%. Again, Apple has a certain, some company has a certain cycle. So September is their typical launch of the new model. So December, the result may be showing last quarter result. So you need to look at year on year versus quarter on quarter, partly because there is a seasonality on the shares and all things. But again, if I look at year on year growth, it's not significant. And the other thing I mentioned earlier, competition. It used to be they took on the China market when Huawei was out. August last year, Huawei came back again with their Mate 60 Pro and all things coming in. And this is eating their lunch now. So certainly is affecting their profit and also their top line. And it's also affecting their price movement. Somebody asked about Adobe. So I actually last minute pulled some Adobe data. Again, Adobe is interesting. Adobe is actually was one stock that I also interested to see whether it's going to move very high and all things because it's an exciting stock with all the graphic and AI related stuff. I did attend one of their seminar about some of their graphic design and all things. But if I look at their growth last year versus this year and their quarter to quarter, not that impressive, although it's still doing. So you can see that in quarter to quarter, as their what they call that, their profit is only 5.7% and 3.2%, marginally higher. Their price suffer partly because this may be the higher PE price that it dipped down. So why I do all these slides is partly because I just want to share with you when you all want to ask us what stock to buy and all things. Actually, all movement depends on a few key areas. Can a company consistently deliver growth? Growth drive PE. If the growth is very fast and very high, your PE tends to be not the typical normal PE. Okay. And the company outlook, what they say about the future growth and all things. And I think the video was talking about their AI is still a lot of shortfall and all things. That's why the excitements go in. And again, I want to stress in rate is that the price always moves in anticipation or reaction to performance and all things. So a lot of time, people are emotional. They buy ahead of the news. There's a saying that what you can buy on news and sell on facts. That means when the result come out, then you decide you better sell. Okay, so something to that effect, you need to understand the emotional part of the price movement. Okay, so then I did a comparison of Cisco.com bubble during that time rise and the NVIDIA current AI rise. Okay, this is a monthly chart. I would say that the NVIDIA has surpassed in terms of speed and height of rise 20 times, probably because the last few years, there's so much liquidity in the market, the QE and all things, it helps them to push even faster. Okay. But again, this is just a quick comparison of Cisco.com because Cisco was also one phenomenal stock that went up from a few dollars to $70, $80, then it came down. So NVIDIA, there was a saying, and somebody actually quoted it, if you bought NVIDIA at its launch price, I think it was $14, if I remember correctly, and you buy $1,000 worth of $14 of NVIDIA stock, you keep until today, it's worth about $3 million because of the growth. Okay, so again, if you can take it that way, you would have made a lot of money. But this is my last slide. I just want to call out. Remember, .com also burst. There was during that .com, I remember I still working and that period, I also jumped into Yahoo and some of the Google and other stocks, but some of them has gone away. Okay, I don't think NVIDIA will go away because they have an AI age. But is this the right price to go in? I think you have to assess yourself and have to decide what's the right movement to go in and all those things. Again, when it's very hard to time the market. So stay invested, but know what you're investing, know your investment. That's a key thing. So never invest in a business that you do not understand. That's all for me. And let's see the question that I saw some question. I see whether did I answer all the question in there or not. So what's your current view on recent US market? It's all-time high, so has to be very cautious. But I do feel that the momentum probably can still last until April, May. I would say, partly because I think there is still this U.S. election, the good news, the good things that we have to continue and all stuff, and I think the AI movement, and there is also recently there's also another news story. I'm not sure whether you're aware. It's called crypto, the crypto ETF. So I forgot to mention some of this huge spike increase in pricing and all things is partly because a lot of AI ETF came into the market. A lot of AI ETF means that this ETF will buy into the stocks or buy into the respective area when AI went up, everything went up. So it helped to duplicate or multiply the increase much faster because of the exposure to AI and all things. Last month or beginning of this month, crypto ETF also come in. Although crypto went up and came down recently, I think there's a new push for the crypto ETF, and you can watch on those areas. Doesn't mean that it's time to go in, but maybe something that we will need to see how it's progressing on that. So I will be careful. I think I still like the traditional good stocks, fundamentally strong, maybe consumer stable, or maybe related to certain commodity. If the economy growth, commodity will go up. So those are the stock I still will be more interested. Some people ask what fund, 6% dividend and all things. I guess nobody can guarantee what's the best, but Pinko at the high yield right now is still a good area to invest. Okay, I have updated quite a bit on US market outlook, so hopefully that cover. Is there a second wave of inflation? Very likely there is some slight increase in inflation, but I think the question is about whether the oil price will go out of control or the shipping cost will continue to be so high and it will impact the CPI. Okay, so the earlier slide that I shared about the shipping rate and all things at the Red Sea may have impact. If we continue to drag on at a 3,000 plus high level, it will impact them in 3 to 6 months, which is why I say maybe up to April or May, because the impact of all these price increases may not come immediately, but maybe 3 to 6 months down the road. So that's why I'm still pretty positive about the next 2 to 3 months. Okay. AI stock, there's so much hype about it. I think AI stock is still there. However, go in at the right pricing, not to chase it at a high point. I think always you can use technical chart, or you can see what's the right time when people are panicked, people are scared, you should be hungry. So that's a key thing. When is the correction due? God knows. We know the inversion until so long, nothing happened. It will happen, likely post-election, because this is US election. A lot of time during the election year, all current president want to make sure it doesn't go into the recession. They want to go in with a good track record so that they can win the election. So that's partially why things will look good for at least the next few months. But there's a suspicion that I see that if their bond sale has been so high and they cannot get through within the next 3 to 6 months, it may impact the second half. Okay, so that's just my opinion. I might be wrong. But again, please, as what I did in the NVIDIA and tech stock, when you buy anything, know your investment, know their growth, know their top line, know their bottom line, know their outcome, know their strength, know their competition in order to decide whether to buy or not. Okay, thanks.
Okay, thank you, Chung Wee. Okay, so we have given every one of us a very comprehensive update on the market, US market. Okay, and really, if when market will correct, nobody knows. But you see, you correct during the time when are least expected. Okay, when everyone hope that you correct market, when think the market will rally, the market will just correct. Okay, so anyway, we are running behind time. So let me just give a fast update on the market for Asia, because there's someone keep asking me about Asia market. Because we have been talking a lot about Asia market, US market. Maybe I just share with everyone this chart. Okay, some of you may have seen this before. Okay, this is the global and Asia equity market performance. And you read the news, a lot of people tell you that Japan is the best performing market. Okay. But from this table, you can see that actually Japan is not the best performing market. It's Taiwan the best performing market for 2023. Okay. Why is that so? It depends on how you want to look at it. Is Taiwan Taiwan is a market, but I don't think you can call it a country, but it's still a stock market there. Okay. And this is in US dollar terms. To take note, this in USD terms. So depends on how you look at currency also for you, because I think yen have dropped a lot, although the market went up. But do take note the compared to US dollar, I think they lose out. So Taiwan market actually made 31% last year. US actually lose to Taiwan. Okay, followed by Korea, followed by India, then Japan. Okay, then of course China is the one that ranked the bottom. Okay, ASEAN, including Singapore, is ranked also towards the bottom, which you see last year Singapore market don't really perform. Okay, so this is how the market have performed for last year. And as mentioned, we also say that you don't see a market be top market every year. Okay, be the top market every year, and you don't see a market that's bottom every year. Okay, and you can see Taiwan 2022 is the worst market, and 2023 is the best market. So would China 2023 is the worst market? Would China 2024 be the best market? That's anybody guess. And a lot of people tell China is cheap, can buy, because it's the worst market. So how worse can it be? Can it become more worse or best? So depends on how you view the market as per se. Okay, but let's look at annualized return over 10 years. Okay, Taiwan is still the number one. Give you a 12.3% return per year. It beat actually the S&P 500 by 0.3%. Okay, so Taiwan actually outperformed US. Okay, followed by India, then followed by Japan. Okay, and China is surprisingly better than ASEAN. Okay, which mainly comprised of Singapore. Okay, and I think which is why STI market can be quite boring. So this is something for knowledge and information. So this is where the market is. Okay, later, and this is on bonds. Okay, this is on bonds market. And what is the best performing market last year for bonds is high yield. But to take note is US high yield. Okay, is US high yield is the best performing market. Asian high yield is ranked bottom, but it's not the worst. Okay, but in general, all fixed income give positive return. Okay, all fixed income gives positive return. It's just that how positive is it for 2023? But over the years, you can see DM, for those who don't know what is that, developed market governments. What does that mean? It means that, like, for example, US government bonds, UK government bonds. Okay, developed market are mainly actually talking about US. Okay, per se, 3% will be US, then followed by maybe 25% will be Europe, maybe 10% will be Japan. Okay, so in developed government bond, that's called investment grade bonds, and actually it's the worst performance. Okay, over 10-year period. Okay, but because of current high interest rate environment, a lot of people buy T-bills, all these things, thought that they give good returns. Okay, but you can see cash give 5.1%. Okay, so this is on the market performance on the bonds aspect. And now let's move on to look at asset class. Okay, asset class. So who is the best asset class performance? Developed market equity give you the best performance. Okay, and which one give you the worst performance? Cash. Okay, cash is not king. Okay, fixed deposit return, all this give you so high return. To a lot of people, it's very high return, but compared to the market, actually they are the worst performance. 5.1% return. Okay, but so that's something for you to take note. Cash give 5.1% return, but it's the worst performance among all the market. That means for those that didn't invest, okay, of course you must invest correctly. Okay, for those that invest right, you make a better returns compared to those of them that just put in Singapore savings fund, put in T-bills. Okay, you get a much superior return on that. Okay, despite cash can deliver a 5.1% return. Okay, but over the long term wise, developed market still the one that stand up. Okay, and actually mainly driven by US. Okay, mainly driven by US and emerging market. Okay, ex Asia. Okay, so to think about emerging market ex Asia, what does emerging market ex Asia means? Middle East, okay, Africa, Latin America. So these are so-called emerging market, but exclude Asia. And they are the worst performance. And you can see the emerging market ex Asia constantly, most of the time, always rank bottom one. Okay, rank bottom. So sometimes try not to invest in those more exotic things that is too far away that you don't even know what's happening. For example, Turkey stock can make a very good return, but in general, Turkey belongs to emerging market ex Asia. Okay, unless you know something about them, but over long term wise, they are the one that give the worst performance, and they are the one that give the highest risk. Volatility is a risk. This one is the return. Okay, emerging market forever emerging. Okay, emerging to be the best. Okay, so that is something to think about. So Asia is still better. You can see Asia Pacific ex Japan is still better. Okay, so sometimes so investment can be quite simple. Don't try to be more creative. Think, wow, all the some people think, wow, frontier market, all these things. Okay, try not to think too far. Okay, stay put. US is still the number one boss in the whole world. Okay, and I would say that you really want to make money, I think we still need to look at developed market equities. They are still the one that control the whole world. Okay, okay. So just make it simple. Don't go and think, wow, some people tell me, I want to invest in Sri Lanka. I think it's frontier market. I want to look at Brazil. I try not to be too complex on that. Okay. Next is. This is commodity. Actually, I don't look at commodities. But a lot of people always ask me commodity, and this is just to show you because I don't like commodity myself. One thing is they don't pay me cash in dividends, and the other thing is their volatility is really high. Like gold, 35% volatility. Okay, so when is a good time to buy gold, and when is a good time to sell gold? To me, I also don't know. A lot of people think, oh, gold, buy gold bar. Then the question is, you only make money when you sell the gold bar. You don't make money. You keep the gold bar in the safe for the next 10 to 20 years. You don't make a single cent of money. Just if you save that, oh, you got gold bar in the safe. Okay, so this is why I don't like commodity. To me, it's mainly for trade, speculation. Okay, some of you actually will ask me where I get this information from. Okay, this is actually from here. Okay, JP Morgan every quarter they will publish this thing. Actually, this is an 80 over page slide. I just extract the key slide out only. You really want to know what they say in more detail, can go and look for this JP Morgan guide, Market Insight. They do that every quarter. Okay. I mean, they're mainly so every quarter they just email to me. And most of the time I don't open because every week they send me email. Okay, so that is on that. Okay, but now let's go straight to China, Japan, okay, and Indian market because there is a lot of people ask about how to invest in these two markets. Okay, let me just go straight to here first. Go to here first. When it comes to invest in this market, a lot of people ask, can I buy ETF? Okay, so then let me just go straight to this thing. Okay, ETF. You go to SGX website. Okay, first, okay, you go to SGX website. You go to ETF screener. Okay, ETF screener. Then you say that you want to buy equity. Okay, about equity. And you choose something called Japan. Okay, that's only one. And this one is new launch. Okay, so this is why a lot of people think it's cheap. Why they launch this one? Because Japan market is so hot. So to make money, people launch a new product. And a lot of people rush in to buy. Okay, but thinking that it's an IPO. So that is the only one. So it's very, very new. And you say, I don't like to buy new things. Okay, so this is a very, very new one. Okay, that's called the Lion Nomura Japan. Okay, I don't know what's the full name. Japan Sing dollar and US dollars. Okay, so this is one. Okay, then if you want to buy India, you go to here, click here, India. Oh, got 3. Well, India climate change one. India climate change, I also don't know what is this. This one, Amudi, MS, India, US dollar. Okay. And this one, I think this one is not a synthetic ETF. I think this is a synthetic ETF rather than a physical replication ETF. Okay, so that you don't have much choice, okay, to look at that. And what is the portfolio? I don't know. You need to click on that. Okay. Okay. I'm biased. Actually, I don't like this ETF. Actually, ETF you want to buy, I always say buy US one. Singapore to me, not worth buying. Why I say that? Let me just show you something. Okay, let's just go to this SGX website. Okay. Anyway, this is not recorded, so SGX also don't know what I say. Okay. We go to trading summary. Okay, I click on that. What India, what China, all this, a lot of people say want to buy those ETF. Okay, and you listed on SGX. Let me just show you this thing. When it comes to buying ETF, okay, key thing is called liquidity. Okay, key thing is called liquidity. Okay, and you can look at this is the liquidity of ETF traded. Equity ETF, 154 millions. Okay, it's a lot. It's not a lot. Okay, Singapore trading volume one day about 1 billion. Billions. Okay, so this is 154 millions. Okay, it take only not even 20% of Singapore trading volumes. Okay, and this is for 1 month. No? 1 month. Okay, so and from there you look at the top 10 holding of the ETF. Okay, by volume. Okay, we just use year to date lah. Year to date, and this is how many months? This is which month one? This is January. Okay, and January very little. Okay, so you can see that there's the top one Hang Seng ETF. Already 50% of the volume is made up by one ETF itself. Okay, and you look at the number 10 ETF, SGX for about 50 over ETF. Number 10 ETF, Southeast Asia Tech, it only contributes 1.3%. So what about the rest of the 50 plus? And where is Japan? Where is India? Where is China? All these ETF. It's not even in the top 10. So what does it mean that you have to buy those ETF? Indirectly tell you it's very illiquid. Okay, when illiquid indirect means what? The spread is high. Okay, and when illiquid, it also tells spread is high means the AUM of the ETF is low also. And when the AUM and the ETF, when the AUM and is low, it will mean that the ETF is not cheap. A lot of people think that ETF is low cost. Yes, if you buy US ETF, confirm low cost. But buy ETF listed in Singapore exchange one, majority are very high cost. Okay, majority are 20 times, 30 times, or it can be even 100 times more expensive than the US ETF. Okay, so this is something to think. So what are the alternatives? Then you really want to look at those Asian market. Okay, and you can go to US to look for the Japan ETF. You can go to US market to look for India ETF. The volume will be definitely better than Singapore SGX. Okay, but do think that they are always traded in USD. Okay, so that is another part. And if not, then unit trust, that's another alternative we can look at. Okay, in fact, for Asian market, I think unit trust will be a better option. That's my personal view. And you ask me what unit trust you really want to invest in the Japan market. Okay, this is not a recommendation on that because I myself never buy. Okay, I myself never buy, but just share with you. If you really want to look at Japan market, let me just pull the Japan out. Okay, and I just use Sing dollar. Okay, and just Sing dollar out, and you go and look at 3-year performance. Don't look at 1 year lah. 1 year not meaningful. You can see 24%, 20%, 30%. I think, and what is the more popular one? okay, you can see East Spring happened to be the top, okay, but do take note, their volatility standard deviation also higher, okay. So you see what is the more popular one, not I recommend one, it's more popular one, most people buy one, is they buy the Nikko AM Japan Dividend SGDH ETF fund. Why? Because you pay dividends. I think the dividends quite high some more, 5 to 7%. Okay, 5 to 7%, and they pay monthly dividends. Okay, but do take note, Japan stocks don't really have good dividend stocks. So the 5 to 7% dividend come from where? So this is something you need to tell yourself. Okay, it's come from because Japan stocks have rarely so high, and they make so much capital gain, and thus they can take the capital gain and pay out as dividends. Okay, but what happened that no market can be high all the way. Okay, and because I think people don't like China, all the money flows to Japan also, and India. Okay, so what happened one day, everyone go back to China, then this market will come down. Then will these stocks able to pay you this type of high dividend again? There's two possibilities. One is they cut dividend. Number two, they continue to pay dividend, but they pay from capital. Okay, because I asked Nico before whether they'll pay from capital or not. They will never give me a yes or no answer. Because at the point, Japan market is very hot. So they say now they pay from capital gain. But when market down, would they pay from capital? I think they have not this. Okay, they've been there for very long term already, but the fund size is a bit too small. Okay, so these are the part. And next, if you look at India market, okay, for example, just for information, I think Nikko AM beat the Japan index. Okay, when it comes to unit trust, you also want to buy unit trust that beat the market. I think they beat the Japan index, if I'm not wrong, based on my last check. Okay, India market. Okay, so the good part about that is that CPF can invest. Okay, I think Japan market, let me just go back to Japan market again. Just CPF can invest. Okay, and go back to Japan market. Also CPF can invest. Nikko AM Japan, so this is why if you CPF money want to buy into foreign market, unit trust is the alternative for you to go in. You can't use ETF. CPF will never approve those ETF to be allowed for investment one. Okay, so CPF will tell you that which one is investable, which one is not investable. CPF board is very strict. Okay, people tell ETF is low cost, but they say sorry, all those ETF are not CPF approved. You want to use buy market, they say can buy unit trust because to CPF always look at cost and performance. Okay, so indirectly they tell you that this indirectly give you better performance over cost. Okay, so that is on that. Okay, but for India market, you see, you just put the CPF aside. Okay, you just put the CPF aside, just put everything in. Okay, which one is I always use a long term 3 years. I can see Line Global, but this fund is a bit too small. I personally like FSA Regional India. Okay. First thing, the fund have been long history. Okay, long history itself. And Line Global India also very long history, but it's a Singapore fund now, so fund size a bit small. Franking look good, but I personally don't like franking fund. So that's my personal preference over the years, my experience with all those fund house. Okay, so but you can decide on what you like. Just to show you that these are all the fund house that can make. So you have actually a lot of choices. Okay, a lot of choices. But do take note, all these are called, India is really a country fund. Japan is considered not a country fund because it's a developed market, third biggest economy in the world. Okay, it can be part of a portfolio, but it should not be the core portfolio. The core portfolio is still US and global market. Okay, US and global market should be still your core portfolio as they are the one that drive the growth. Okay, on that. In Japan, we're having a recession now. Market, I don't care about all these things. Okay. How about trading STI ETF? Any choice of instrument? Actually, STI ETF, only STI ETF. That's the only one, unless you buy unit trust. Okay. Unless you buy unit trust, then you can look at Nikko AM. They pay dividends 5%. Okay. So that is on this aspect. Okay. Next is risk market. To risk market in general. Okay. When not only risk market in general, so debt heavy companies, okay, will benefit from interest rate cut. Okay. Debt heavy company like property sector also considered debt heavy company. Engineering company that need to borrow money. Okay. Oil and gas industry that need a lot of debt. Okay. Even cruise line, all this, they have a lot of debt. They will benefit from the interest rate cut. Okay. Just that interest rate cut don't cut steep and direct. Okay. They cut slowly. So it's really a long-term game if you are looking at it. And of course, find out the fundamental, buy a good companies. A long-term, they'll write off. Today, I'm not going to talk about what. I don't think I have time to talk about that. Okay. If you want to know more, I got actually this month, March, I'm going to have I'll do a few rounds. I want to talk about Singapore dividend stocks. And now I'll just 2 hours, just talk about REITs. Talk about what REITs you can look at. Okay. And then this one I'll post in the chat. Okay. Later when the date is finalized. So that one, then I'll talk more about what REITs you can look at. And to me, REITs definitely is a way is definitely not out, and it will definitely benefit from the interest rate cut. Okay, so that is on my part. Unit trust, and this is always a misconception. Okay, this is a misconception. Okay, on that, you rather pay a low-cost ETF fund that they don't perform well, or you rather pay a high-cost unit trust fund, okay, that perform better than the market. Okay, so this is your choice. Okay, some people always have misconception. High cost doesn't mean don't perform. Low cost doesn't mean you performs. Okay, so sometimes you pay peanuts, you may get monkeys. So that is something you always look at performance. Always look at returns. The returns net to you in your pocket is the most important part. How much cost is paid is not important. It's that how much return you get is more important. Okay. So you look at the world best hedge fund managers, their cost is very high. But why a lot of people give it to them? Because they make returns that's way more superior than the market. So people are willing to pay them high fees, okay? Because ultimately the return they get is so much better than just buying into those low cost funds. So ultimately always look at the returns and the risk you take. Okay, that is the most crucial part, not the cost you pay. Okay, so that is on that part. Okay, so this is on this part. Okay, so now let's look at, and the side show all are sharp ratio, but most of them all beat the market. Means the market, the ratio will be lower. Okay, so you need to go and compare whether they beat the market. Don't look for funds that underperform the market. Look for funds that outperform the market, and there's quite a number of funds that really outperform the market. Okay. Okay, now let me bring Elijah to talk about the other part. Elijah, are you there?
Yeah, but I have a challenge. I have 5 minutes.
Yeah. Okay.
No problem. I see what I can do. Okay. Good evening. Oh wait, my camera. Okay. Good evening, everyone. So actually, this is a portfolio spring cleaning part lah. But let me skip over a bulk of it because I only got 5 minutes. I think the key thing I want to share is I'm not sure how many of you are aware, but actually in October last year, MAS actually launched a basic financial planning guide, which is also one of the reasons why we wanted to talk about portfolio spring cleaning for today, because this guide, this year, they actually break it down further into a few sub-guides, which basically cover, are you a fresh entrant to the workforce? Now you may be, right? Let me see, where's my pen? So are you a fresh entrant to the workforce, right? Are you one? Are you someone who is starting a family? Are you someone who is supporting aged parents, or both, right? Starting a family and supporting parents? Or are you someone who's preparing to retire? Or are you someone who's already retired, right? So what I will say ultimately is that they have put forward a few rules of thumb. They have stated that regardless of age group, they've always mentioned 3 to 6 months of expenses. Death TPD cover 9 times annual income, CI 4 times annual income, and most 15% on insurance. Is with the practical experience of having worked with hundreds of families over the years that I can tell you that their numbers are good for a starting point, but I actually do disagree with a few things. Okay, first thing is 3 to 6 months expenses is actually quite insufficient in this climate. I have seen people who got retrenched, and it's not 3 to 6 months that they couldn't find a job. It's easily 3 to 6 quarters, because I really do have a friend. He got retrenched at 28 or 29, I think. And he took 15 months, or basically 5 quarters, right, before he got another job. So, and he was not even 30 at that point, right? So it's totally possible that you will be very tight for very long. So please do a bit more for yourself. I know that, like all the money sitting there doing nothing. Well, of course, we always have SSBs and things like that to park your money in. Okay. These numbers are not too far off, so that's fine. But I also disagree with 15%, because you should not really be spending more than 10 if it's about yourself, and provided you're healthy. Okay. So I think the most important thing, which I will just share, this is from practical experience. And if you all want to take a picture, go ahead. But this is a guideline, it is not a recommendation, it is not advice. Your situation will differ. I personally think that as fresh grads, you probably won't have a lot of liquidity saved up. It takes time, right? But once you are starting to move towards parents or whatever, right, you should have more and more liquidity. And we always say that retirees should have 36 months of liquidity. Liquidity doesn't mean your money's in the bank. Your liquidity just means that this money is accessible to you and it's not at risk. Okay. Coverage for death TPD, actually it's not death. Like, you're a fresh grad, no one's worried about death. It's TPD, because if something happened to you and you are not dead, but you are unable to work permanently forever, then you're going to need money. That one, I can assure you that. Okay. Just Google the case of the brick line banker who got into a car accident and can no longer work again, but they still need money for him, right? So that's the general idea. Okay. Death TPD is unlikely for a retiree. Okay. And then pre-retiree, of course, you still need some. You don't want to wreck your retirement plans. CI 4 to 5 times is probably a good measure. Once you have a family or commitments, you want more, but your situation will differ. Okay. If healthy, your premium should never be more than 10%. It's quite doable, actually. If you're a sole breadwinner supporting kids because you're a parent, 15% is probably a good number. So these are some of the things that I think everyone should take note of. But again, this is not advice. This is just from practical experience, what myself and the team have seen over the years. Okay. And of course, even in retirement, you do need some coverage for CI, because you will still incur costs, especially now that hospital plan don't cover every single payment. So this is just my general guide for all of you. So, I think it's always good to once in a while take a look at this. Wherever you are on this list, right? And then are you more or less in line with these targets? And I'll say that if, let's say, you are 5 times annual income for critical illness, you're fine. You're 4.8 times, it's just 0.2 times lesser. It's not necessary to plug the gap. Over the weekend, I was talking to this doctor. She earns about 200K a year. Okay. So she also only got 200K of CI cover, right? So she's a parent, 5 times 1 million, right? So that gap, right, is 800,000. It's too big to ignore. But if she already has, say, 900,000, I probably don't think she needs to do anything. So that's what I mean. You got to see your gap relative to what you need. Okay. One piece of advice to everyone, please don't need to review your insurance all that often, because it's more or less major life stage event. You get married, start a family, buy a house. Or if you don't really have any major life stage events, but it's been 3 to 5 years since your last review and you just wanted to make sure everything's still fine, please check in with, you can check in with us, or if you want to speak to us, we'll give you a very objective analysis of the situation. So that's why I really wanted to say, that's spring cleaning your portfolio. I had mentioned on personal budgeting, but I think there is no time to really elaborate because it's 9:31 already. Maybe I'll cover this in a future topic. So personal goals, personal portfolio, I'll just say that if you can't afford to raise the money, like if you need money for renovation down the road in 1 year, for example, this is not the money that you should invest. Okay, that's like 1 to 3 years, you shouldn't invest this money. 5 years and above, you can take some risk. 10 years and above, yeah, you definitely can take risks, but please pair it with risk-off assets, things that are safe, so that you're not unduly exposed. Okay, I just want to take the opportunity to address a couple of questions. from all of you before I hand back to Darren to end. So someone asked this for balancing, do you base on the investor amount or the market value over the whole portfolio? Actually, I just personally, right, I think it is just ultimately what is your allocation and how close are you to it. So for example, if you have a target allocation of say 40-60, okay, 40 bond and 60 equity, okay, and your current portfolio is showing that is maybe 70% equity and 30% bond, okay. Assuming this is what you wanted, 40-60, and you're now at 30-70, you know that equity is outpacing your bond. So that's the point where you say, you take a little profit and move 10% over into bonds. That's how I look at it. Now, having said that, if you are 39% and 61%, right, you probably don't need to do anything. Right? You're just 1% off. So it's all relative. Okay. Then next part of this question also is, when do I recommend DCA? Personally, DCA must run out long enough before you see the effects. And my recommendation is you should have enough time to DCA over at least one, if not two market cycle. Okay, at least one, if not two market cycle. And you cannot stop. The problem is a lot of people stop their DCA, and that's when the market's not doing well and then they stop, and that's actually when they should actually continue in order to see results in the future. So DCA, you must find something that you can comfortably afford and continue at least over one, if not two market cycle. That's my take. Next question, should we average out cut loss or just sell stocks bought at high price? Okay, I will say it all depends on what the stock is, right? So for example, you see potential in the stock, but maybe just a one-off bad market news has caused the price to drop. Actually, you should be doubling down. And that's assuming you believe in the stock. For example, when COVID struck, all the banks dropped. But we all know that in Singapore banking system, banks are relatively good players for dividend players. So like when OCBC dropped to A+, I just scooped up some more, right? So even though it dropped, I was actually below my initial purchase price, but as if the potential, like Chewy mentioned, the future potential of the company is still there, then there's no issue to increase your allocation. Just don't overdo it, okay? But for selling, of course, if you think you want to take profit, there's nothing wrong, okay? But understand that something that go up can also come down, but something that go up can also continue coming. Like Chewy mentioned, he exited NVIDIA a little too early, even before it hit 700. So he missed out that. I can feel his pain also, but if we had a crystal ball, right, but now us have that, then obviously this doesn't happen. So just understand that you never have a crystal ball. If you can take profit, you should be happy, because there have been many situations where people want to take profit, they kept waiting, and in the end, the profit came out the way back down because the stock dropped. Okay, so that's my take. And then the last thing, because I kept myself to 10 minutes. Okay, what's the POEMS? Someone actually asked, what's POEMS current MMA promotion? Maybe you missed out the Ask Me Anything last month. So just to recap, there's currently a MMA promotion whereby if you get a qualifying insurance policy, it should be saving or endowment. We don't really do ILPs here. Okay, you can then put your money inside money market fund. We give you guaranteed 6%. That's all I will say. But just remember, it's very important that you need to first have something suitable that you are looking for. If you are not looking for a saving or endowment plan, please don't find one just for this promotion. But if you are already thinking about it, then maybe talk to us and we see if there's something suitable for you. And if you take it up, then of course you'll be eligible for this promotion. So I think I don't want to overrun too much. If you have questions about the 6% MMF, please talk to us. Okay, Darren, I finished in record time. Back to you.
Okay, thank you, Elijah. There's a question. You want to subscribe for the Poem Live price? I think you have to go to Chrome Poem website to subscribe. Don't think the apps currently got feature for you to subscribe for that. Okay, on this. Okay, we have run this for quite a while already. So and next month we will have another AMA. Okay, but the date we'll let you know later. Okay, because next month I'll be traveling. Elijah traveling soon. We also are traveling. So we need to find a date that three of us can come together. Most likely will be in middle of March.
I'm not traveling.
Oh, sorry, you're not. Okay. Okay. We'll be doing in middle of March, but we'll let you know. Also, we'll value your feedback. Do let us know what are the topic you want us to talk about. Okay. And any final words from Chumi and Elijah before we end the session today? Chumi, got anything to add?
Stay invested. I would say if you are keen on knowing about China stock, maybe look at the A50 index and see whether it continue upward or not. That's another way to look at China stocks.
Oh. And A50 index, you want to look at ETF, I think there's a UOB ETF. Okay,
yeah.
index.
I think in the Hong Kong stock, there's a 02823, if I'm not wrong, is a ETF also.
So you look at ETF, don't buy the Singapore one, buy the Hong Kong one.
Yeah, Hong Kong one is more liquid.
Yeah, give you more liquid.
Yeah, 2823.
It's not that I don't like SGX. SGX is a good shares, but the Singapore ETF market is really, liquidity is really a big concern.
But maybe just to add, I think I still want to be cautious of China, partly because a confidence building takes long time to get back. When the whole the economy is kind of slowed down and being very conservative, Asian tends to be very careful in their spending. So I think the government is doing a lot to spin off, to make it easier, to reduce the loan and all those things. But there are internal factor. There's also external factor. The Western, if investment firm is putting a negative view about China and more positive view of India and Japan. But like what Darren says, sometimes you look at the chart on all the different markets, no one market stay low all the time. So it's a question of when. I would say probably good to see currently, but I think the second half is likely going to be a challenge for all the market second half.
Okay, stay invested and stay diligent, and sometimes you may need to move around the shares when you see something is not right. Okay, if not, we'll end the session today, and thanks everyone for attending the session. Okay, hope we have gained some insight for today's session, and have a good evening, everybody.